say FTX that collected billions and billions of dollars, but never bought the Bitcoin, actually. So why is this a problem? If FTX stole billions of dollars in a BlockFi and Voyager and Three Arrows and Celsius and Terra Luna, if all of those ecosystems basically collected people's money and then lost all the money, then people that legitimately wanted to own Bitcoin had their money stolen from them.
In a recent interview, Michael Saylor, the executive chairman of MicroStrategy and a prominent bull, discussed his views of the demise of the FTX Empire. The FTT token, which SBF's business was in charge of creating, provided customers of his exchange with a number of advantages. The asset, which was formerly among the top 25 cryptocurrencies, experienced a value fall of over 90% last month amid a run on FTX, which was immediately followed by its bankruptcy. Freed's use of FTT and other tokens as collateral for loans, in the opinion of the Saylor banker, was particularly evil considering their relative immorality. Goldman Sachs and other conventional banks, however, would not agree to provide a loan against such a dangerous collateral. So SBF took matters into his own hands, utilizing Alameda to borrow money from FTX customers against the FTT collateral. Then Alameda used those funds to support the price of FTT, enabling the company to borrow additional capital and transfer cash to SBF's parent company, Paperbird. The greater crypto community and the Bitcoin community have allegedly been engaged in a low-grade, simmering guerrilla war for years over what sailors repeatedly referred to as the sin of shitcoinery, industry practices. The latter was exemplified best, in Saylor's opinion, by FTX founder Sam Bankman-Fried. Ability to create your own unregistered security is unethically flawed. Sam and the majority of the crypto community, according to him, were perpetual sinners who engaged in shady coinage. Such behavior, according to Saylor, is caused by the underlying issues of greed, arrogance, and stupidity among the crypto community. The diabolical twist in the FTX narrative, according to Saylor, was SBF giving himself billions of dollars in loans and generating billions of dollars from tokens he produced out of thin air. The community on Reddit praised Saylor for his concise explanation of the problem and an honest comparison with Bitcoin, despite the fact that many have refuted the account of SBF and his mishandling of assets. Saylor's remarks about the FTX incident were not his first. Along with Changpeng Zhao, CEO of Binance, he was one of the first to call for self-custody in the early stages of the unwinding. As Nono even provided a brief explanation of what digital assets are, he also discussed cryptocurrency regulation and how challenging it would be to implement such regulations. We'll now play the video to hear Michael's thoughts on the FTX crash and how it affected his beloved Bitcoin. Please enjoy the video, subscribe, and leave comments below.
We know they gave them billions and billions of dollars of credit, right?
Mm-hmm.
Maybe up to $10 billion of credit.
Well, how much did you get as a bona fide MicroStrategy CEO when you were in the market trying to raise cash, right? There's the direct comparison that we can use.
Yeah. If I were to go to a bank and say, I have some locked MicroStrategy stock, will you loan me money against it? They would say no, zero. If I went to them, zero, right? The answer, by the way, to the question is a disinterested CEO of a crypto bank that was honest and competent would have lent Alameda somewhere between $0 and $10 million.
Right.
Like the number is not one order of magnitude less. It's not even two orders of magnitude less, right? It's somewhere in the range of 3 orders of magnitude less. If you were honest and competent, you would basically say, well, what is 5% of the honest trading liquidity in the token? If the thing trades 100 million a day, but 80 million is wash trading, there's 20 million a day. Well, how much of that is trading on another exchange, not your own? Oh, 3 million a day. Okay, so $3 million of this stuff trades on another exchange. Can I trust that one? No, they're not. None of them are regulated. Okay, how much trades, on any regulated exchange? Well, of course, none of it, right? But let's say I threw out the issue of a regulated, transparent exchange. I just said, well, how much trades on an exchange other than one you own? 10 million. Okay, I'll give you 10% of that. I'll give you $1 million of collateral value. Okay, how much could you borrow against $1 million in collateral? Well, the max is 50% loan to value, 50. So I will give you a $500,000 loan against $8 billion of FTT token. That's the right answer if you're honest and competent. So obviously that didn't happen. The reason it didn't happen is because you had 3 related parties all terminating with one boss, and the one boss was not honest, not competent, and not disinterested, right?
Mm-hmm.
A biased, dishonest, incompetent person. Okay, what could go wrong? Well, when you have 3 related parties and a biased, incompetent, dishonest person, what can go wrong is the entire thing gets burned to zero. And is that likely? Yes, highly likely. It's not even just what could go wrong. It's highly likely. That's the reason there's a stigma attached to related party transactions. You would never want the CEO of a bank to be issuing loans to a private company that they owned, right? I mean, like, if it turned out that the CEO of JP Morgan was issuing billion-dollar loans to Jamie Dimon, real estate development company, jointly owned with him and his wife, right? People would just lose it,
yep,
right? For obvious reasons.
So what I can't figure out this part of the story is the SEC, they knew, like, that there's documented meetings between Sam and I believe Gensler himself, if not some of his team. What were they sitting on? I can't figure that out for the life.
First of all, I haven't. No one has credibly documented that there were meetings. We know that there was a calendar entry where someone that worked for Gensler might have had a meeting, but we don't know anymore.
So we're waiting for verification on that. Okay.
I think I've read that there were many more meetings with the CFTC than the SEC, and many more with politicians. But we don't know the content of any of those meetings. No one has made that public. But what is your question?
Where were the regulators? It seems to me as though, like you said it before, were they sitting on their hands? Did they know? Is there more to this story?
The regulators seems like they just don't really want to, they don't feel that they have the authority to regulate offshore entities, right? I mean, that's been the big blind spot.
Because he had it all registered in the Bahamas.
Right. I mean, FTX was in the Bahamas, and so there's this vacuum of power, right? A blind spot where the U.S. regulators don't feel like they have authority to regulate offshore entities, and the action they've taken has been via civil enforcement actions, which are very slow and very expensive, like take years and years and years, and so they have pursued a number of entities via civil enforcement slowly, but they haven't really laid out any global framework for digital assets, and they haven't pursued offshore entities. They haven't even really pursued onshore entities that aggressively. So there's been a lack of effective enforcement, I think you could say, and a question about who should take leadership of it. But Congress has been mired. They haven't passed a law. They couldn't pass a stablecoin law. They haven't passed it.
Saylor concludes that allured traders were tricked into uploading assets to the platform by FTX's absurdly low trading fees, which allowed SBF to easily deal with them. Because of the serious harm it caused to investors in the whole cryptocurrency industry, the FTX crisis is still being discussed even weeks after it occurred. We promise to update this page with fresh information as it becomes available, so please like, subscribe, and set your notifications on.